everyone. I want to thank you for coming to this free webinar for trendfollowingmentor.com, and my goal is to make it very informative and that you can take something away from it that you can use and even actually tell some of your friends. What is the whole idea of Trend Following Mentor? Is really to convey the point there isn't any magical indicator, any magical system, but the idea is to help you develop a plan. And really the point of this plan, it becomes a trading plan, and there's more to it. There's a reason being. The key is to compound money. The key is to be able to follow this plan. What I teach you are very simple ideas that, are robust and simple, that, but yet people have a very hard time following. So it's a twofold process. I give you my exact trading plan, and today we're just going to talk about, two common mistakes that I see over and over again, and even with professional money managers, and that you learn from it in order to not replicate it, and that you can start to develop your own personal trading plan. And when it says talk about a trading plan, the whole concept is like this. If you start a business, you need to know exactly what you're doing. You write a business plan. When people trade, unfortunately, they think it's very easy. They think that, they'll buy a trading robot or a special indicator or a system, and that's it. They're off and running. It's the farthest from the truth. This is not easy stuff. It took me, truthfully, a long time to get it. And really, I was very fortunate. I had several mentors that are older gentlemen now. One started in 1979, another started in 1977. My accountant introduced me to one. My broker introduced me to another. And what I learned from them was the powerfulness of a, let's say, simple, robust system. And I'm going to qualify that too. Even the turtles that were famous in the 80s that just made oogles and oogles of money, they traded something very simple. It was a simple breakout strategy. And within the turtles, you had all different results. And it's ironic because they were all taught the same thing. And there's only one reason they all had different results. It was their attitude. And that's another issue that I talk a lot about, and trading psychology, and it's imperative. Because when you put the plan together, you compound money. This is really what the goal is, to help you compound money. I mean, I'm 50 years old. I'm going to be turning 50 in October. So I'm saying maybe I have another 25 years, 20 years left. If I can compound at 16 times, at 15%, I 16 times my money. I've been doing this already now going on 18 years. I've 8 or 9 times my money. This is what I've learned from my mentors. It isn't like this magical secret sauce or magical indicator, because they don't hold up in the real world. What I teach is what holds up in the real world, things that I do. And unfortunately, and I've had people tell me that, it's not sexy, it's boring. They want something more complicated. But you know what? In the real world, complicated really doesn't hold up. And really, the most important issue is you can trade commodities, you can trade stocks, you can do real estate, you can, I don't know what your business is, you can sell something, sell bubble gum and make money. But the key point is to compound money. Like the name of my programs are called Formula 72. I have a low volatility, a mid volatility, and a high volatility. But the whole concept is to compound money over long periods of time. And when you compound money over long periods of time, and you really internalize this massive point, it takes away so much of the psychological impediments that hurt traders. What do I mean by this? First of all, we have a trading plan. At every one moment, I know exactly what I should be doing, and I do it. Because I know if I don't do it, I'm not going to be able to compound money. And this is what I'm going to show you in these two mistakes that, it ruins the compounding of money. But the other thought is, when I'm talking about compounding money, and I really know I'm really pushing the envelope, keep on talking about it, the fact is, what you learn, and you put things into a perspective that I'm going to be doing this same trading that I've been doing for the last 18 years, I'm hoping for the next 30 years. And do it over and over and over again. Because, and also it's boring. And then even George Soros, and I caught this when I read one of his things, talks about, good trading is boring. That's exactly it is. I look at a chart, and I know what my goal is. If you've seen some of my videos, I have a chart behind me on the size of a wall. Because invariably, when you trade, and I trade, you're going to go through numerous periods, or I'll even say countless periods, that at best you don't make money. At reality is you're going to have multitudes and many losses. Many losses in a row. And many times these people quit when they have 4, 5, 6, 7, 8 trades in a row. They quit. It don't work. But then, you know what? Then you're not compounding money. You're quitting. You can see almost like how I have this chart. Well, we just missed it going back. But that's the type of idea. Keep your focus on the ball, on this long-term horizon. Because when you can do that, what it really means is very simple this. Any one trade doesn't mean anything. It doesn't matter. As long as I keep my losses small. And I always talk about this. There's only 4 possibilities. Big losses, small profits, big profits. If you can negate the big losses, the small losses and the small profits negate each other, and then you stumble in some big moves, not that you knew anything or you were smart or anything like that, you put yourself in a situation to benefit, to catch a trade, catch a trend. So going back to this concept, here's the chart, that when you're looking at this long-term idea, you learn that any trade doesn't matter, that you have to keep the losses small. You learn to have this long-term perspective that, you know what, let me give you a perfect example. Again, I've been doing this for a long time. 2007, 2008 were great for me. While the world was burning and most people were getting blown up in their stock accounts, I had 2 of my really great years. 2005 and 6 were not good. I had my worst drawdown at that point. 2009, really didn't make any money. Nothing happened. 2010, good year. On average, I was up 34% in one program, another one up, my lower volatility program, 11%. And then 2011 kind of stunk. I was down 2% and then down about 10%. I mean, in my more aggressive program. But what does it mean? It doesn't mean anything because I'm looking at how did I do over the last 10 years? Or I'm going to say, well, how am I going to do over the next 20 years, over the next 30 years? This is the perspective. This is what I want to teach you. This is what I want to instill in you. This is what was instilled in me. And I speak about this in my book. I have a book coming out with Wiley Books called The Bible of Trend Followers, coming out in the fall, How Professional Traders Manage Risk and Compound Money, actually vice versa, compound money and manage the risks. I invite you to pick up the book, but this is what was taught to me with my mentors. I also have an article that it's an institutional magazine called Marhedge. And in this Marhedge, they talk about an investor who invested $300,000 in with, actually I mentioned one of the turtles, Tom Shanks, he has a commodity trading advisor called Hawksbill. Anyway, this investor invested, I don't remember the exact year. I can email you the article, and you can email me at andrew@trendfollowingmentor.com. You can kind of see it up here. andrew@trendfollowingmentor.com. I'll email you the article. What I'm teaching you is what this guy lives. This guy took $300,000 to $18 million, plus he pulled out $1 million. I can tell you my stories of the dentist, and I have another colleague who lives in Colorado who's been doing this since 1977. And I'm going to tell you they're not a guru, that they had many losses, they had long periods they didn't make money. But the dentist, who's also from Florida, he started in 1979. He actually, with my accountant, same accountant I have, started with $200,000, and the account also is about $17, $18 million, I guess, approximately. He also has trust accounts for his children and his grandchildren. He compounded his way to wealth. It wasn't that he had a secret sauce or a magical indicator or a trading robot. What he had was a simple, robust methodology, which I'm using. Basically, I'm using his idea. And it's not rocket science. And added my own risk filters that I'll also teach you too. But he was, let's say, confident in his plan. He was focused, patient, and disciplined. Most people, they want it now. They want that secret sauce. They want that trading robot. They want to make the money. It is not reality. That is why most people fail. The majority of traders fail. More than 90% of traders fail. My goal is to prevent you from failing. I can't promise you, but I can sure as heck try to help you and teach you exactly what I do. Are there any questions at this point? If anyone has any questions, I want to go and get to the meat of this, what we're talking about, the two biggest mistakes. Okay. Okay. Let's jump to this. This is a real example. Let me move it over. First of all, I want to say I use Metastock. Metastock is just easy to use. It's simple. It's quick. I've been using it since pretty much 1994. And really, let me go through a reality of what happened. First of all, my trades, they work like this. It's a conveyor belt of ideas. First, I identify the strongest, and I identify the weakest. And I have an exploration, which is here. I don't have Metastock open because I don't want to take up that much bandwidth because I'm on wireless. I'm not plugged into a modem. I'm traveling, actually, for the next 2 weeks, speaking at a convention, at a conference in Chicago, and actually meeting potential investors. So I don't have a modem. I'm doing this wireless, so I apologize, but it should be coming out clear. The idea here, right in here, there's an exploration where I identify the strongest and the weakest markets. Simple. And it's based on a rate of change. Only simple really holds up in the real world. That's the first idea. So really what happened here is I had a trade to buy the Swiss franc somewhere about in here, approximately. And it was a nice trade. And as you can see, I got taken out. What is the idea? Again, I'm going to sound repetitious because some of these names I see from the attendees list are, I'm having discussions with them, many people from all over the world. We use two simple premises. Simple works. Simple works in the real world. I have a trend breakout, which you can kind of see here, and I have a trend retracement. That's it. Two ideas. So I had a trend breakout trade, probably about here-ish, ran it up, and got taken out. When you have a trend breakout, you have an immediate hard stop, because I said with those four possibilities, when you trade, big losses, small wins, or small profits, big profits. Well, the fact is, you need to put a stop in because anything can happen. And this is what part of the premise is going to be. So I had this first trade, took it, and I got taken out. And so you can see this line. It's a trailing stop, which I'm kind of cutting to the chase because that's one of my biggest mistakes that I've seen traders make, is not having a stop, and I'm going to exemplify this. And actually, it's based on a volatility trailing stop, and you can use an average true range volatility stop, or actually I wrote an article in 1998 in Stocks and Commodities magazine, and if you want, you can email me, again, Andrew at trendfallinventor.com, and I'll email the article, again, and you trail your trades. First issue, it was a pretty big move here, and one of the issues is that, when you have a second signal, even if it's down the road, people are reluctant. They're afraid it's too expensive already. It's gone high enough. It's not going higher. I remember verbatim with the internet stocks. We can call it Netflix. We can call it, I'll give you an example. There was a great trade that I was in 2010, cotton. I got in, quiet, breakout, simple, whatever, just like every other trade. I got in around the 70s. Got up to about 100, and I was kind of flip-throwing through Bloomberg, watching a Bloomberg show late at night. And they were having a discussion from experts saying that cotton's over. The move is done. It's not going any higher. And unfortunately, another mistake is people would listen to Bloomberg and then say, okay, they're right, I don't know anything, and sell their position. Well, I said, okay, great. You guys are whatever, the analysts, the experts. My plan is saying stay in this thing, which I did. And it ran up to about 150, and then it turned down to 130, and my system took me out, the methodology. Thank you, next. But what is the point? They said it couldn't go higher, and they thought that high was high enough. Hold on one second. So what is the idea here, using the Swiss franc example, is that people didn't take this trade here, which is kind of dumb. But it's another mistake. It's not one of the typical mistakes, but it's a very prevalent mistake. It's gone high enough. It's not. I want to buy low and sell high. Well, let me tell you what us trend followers do. We're the dumb ones. We want to buy high. That high can go higher, because you know what? Anything can happen. This is another powerful precedent that you need to internalize. I mean, think about the NASDAQ. I had discussions with people that they thought I was an absolute idiot because they were telling me that this time it's different, and that, you know what, they're going to run out of Cisco stock or run out of Sun, whatever the heck it was called. And, you know, I'm not the smart one. So basically, you have to believe that anything can happen. We know what happened to the NASDAQ. We know how that crashed. We knew how that crashed also in 2008. People didn't believe it can happen. As an example, people didn't believe that Enron can blow up. People didn't believe that Netflix can go and implode. Or I can keep on going. Chipolita, the Mexican restaurant owned by McDonald's. Believe, internalize that anything can happen because you're going to protect yourself and your family. I brought that point up, family. And going back on the compounding, I met a potential client to invest in our company. And he has money sitting in his brokerage account. He's not doing anything with it. And he says, I don't like the market now. I said, I'm so glad that you know the future. I said, you know, my crystal ball doesn't work. And he's got a nice chunk of money in there. And I asked him how old his son is. And he said his son is 23. I said, so you're going to tell me that your son has at least 50 years of compounding. Let's say he has, I don't know, 30 years of compounding. You know what? Basically what I told him is, and I said, you don't have to follow my word for it, even though I had my laptop out and internet. I was all ready to go. I said, you know what? Over 30 years, if you can hit 15% on average, not every year, because you could be down a year, you could be flat a year, you can have a 20% year, you can lose a little bit, maybe have a 30%, another year. But after 30 years at 15%, you're 66 times your money. You know what? You don't have to invest your money in what I'm saying or with me. You know what? Have your money work for you. Do something. If you want real estate, do real estate. But you know what? What I love and why I love trend following with commodities, because it's every aspect of our human existence. And the fact is, my money is working for me. And it's liquid. And it's transparent. We had this discussion. He was going to buy real estate. And I said, okay, maybe you're buying cheap. I don't know. It's not my niche. But I said, the idea is that your money needs to compound. But the fact is, I said, you know what? If you want to sell that real estate, good luck. Try selling your real estate in 2007 or 8 or 2006. Good luck. You know what? My whole portfolio, which is about 60 to 70% of my net worth, I can liquidate 2 minutes, 5 minutes. See this little smiley? This goes to one of my brokers. I have 3 FCMs I work with. I spread it out. I don't trust any of them anymore after what happened with MF Global and PFG. So the whole key is to think about your kids. My daughter is 20 years old. My son is 19. So my daughter's got 60 years of compounding of money. That's mind-boggling. If I really tell you this, you're not going to believe it. Hold on, let me just do it as if it's $100,000. I'm on another laptop here. I work with 2 of them. Just bear with me 1 second. 1 second. 60 years at 15%. 1 second, got too many zeros. She basically 438 times her money. Do not take my word for it. Go to a site I'm looking at. It's called moneychimp.com, compounded interest calculator. This is what the key is: compounding money over long periods of time. Forget about how did you do last month. Forget about how did you do last year. Focus on the end game. Focus on the long term. Let's get back to this chart, this Swiss franc chart. So what happened is I had a buy, another buy. You can see this breakout. Nothing, not sexy, not rocket science, not nothing. Fine. And for whatever reason, who knows why, it took off wonderfully. Great. I remember it. I was thinking, God, this is a great trade. At the same time, and I invite you Don't take my word for it, because I'm skeptical. I don't believe anything. There was a money manager named Dighton, D-I-G-H-T-O-N. He was a counter trend. And you have scenarios like people that didn't believe that the NASDAQ would go up, or whatever you want to call it. Let's use this as an example. This that the Swiss franc was overvalued. You can be right and be out of business. This is the biggest mistake. You don't trade your opinions. This is not what it's about. What it's about is following your trend, a trend. You don't fight a trend. People go out of business fighting trends. Dighton, and it's D-I-G-H-T-O-N, capital USA, he had a great track record. Fantastic track record. He did something like 30% for 3 or 4 years in a row. People didn't know what he did. All they did was they looked at his results and said, wow, I'm in. They bought his numbers. And again, I want to make a major point. You have 2 ways to compound your money. You can do it actively yourself and learn how to do it, and it's a process. Or you can allocate it to a money manager who understands risks, who is paranoid about risks, and understands how to be focused. And those guys are rare to find. I mean, guys that have been around for more than 5 years, they're rare. Truthfully, I do both with the goal to compound money. I've been doing my own trading since 1994. I've been allocating to commodity trading advisors and hedge fund managers since 1994. And I had my best lesson in life. Well, many lessons. I'm always trying to learn. One is I allocated $200,000 with a guy. You can check it. It's called Monroe Trout. I basically 7, 8, 9 times my money over 12 years. It was $1 million something I got out, $1.2 million, $1.4 million, whatever. I learned also at that time, I put $200,000 in with Julian Robertson in a feeder fund of his. Prior to that, in the 80s, he had been compounding in the 20% range. I knew what compounding was. I'm saying the rule of 72. How many times does that return 20% going to 72? Means how many years until I double my money? Well, it was every 3 or so and a half years. My money would be doubling. 4 maximum. I was counting the money. I thought I was done in life. 1998, he blew up. So what does it mean that anything can happen? There's no magical manager, no magical system, no magical anything, and you need to be diversified. But the point is, I have been able to compound money both actively with my own trading and money management, as well as allocating to, I'll call them outside money managers, because what happens, there's years I outperform them, there's years I underperform them. That it is what it is. I'm not in any ego trip. I don't care. The only thing I really care about is to compound the money. Going back to being right and yet losing all your money, you know what? The beginning of this move, you pretty much got to the same thing. But you know what? Fortunes were made and fortunes were lost on this big move. And it wasn't just Dighton. There were many other people that said, you know what? I don't buy this trade. You know, they're trying to sell it. People have been doing that with Netflix. People were doing that with Amazon. People were doing that with Apple. The main trading mistake, to reiterate, is not following the trend, believing that anything can happen. You need to do this. Otherwise, you're not going to be in business. You're going to blow up. And trend following is not complicated. It's very simple. You're buying a breakout or you're buying a retracement. Nothing just goes straight up. You have retracements. It goes up. You have a little bit of retracement, a little bit of retracement, a little bit of retracement. Those are lowest entry points. What is the point here? Follow the trend. Do not fight the trend. Let your profits run. I've had students, because when I do the one-on-one mentoring with students, I want to see their charts. I'd say, you know, if you're really serious, because my time is valuable, I said, my goal is to have you succeed. If you don't succeed, it's a black mark on me. So I asked them, I said, send me your charts. I want to see your trades. It doesn't matter if they're doing intraday, daily, whatever. I had a guy that was in a great trade, actually a guy from Australia, and he exited it, not per the plan. And I'm like, I asked him, I said, you know, why'd you exit? He goes, I got bored. And I'm like, well, let me ask you a question. Why are you trading? You're not trading for entertainment. And if you are, you're going to blow up. You should trade for one reason, to support your family and to compound money. Compound money for your children and teach your children how to do this. So he got bored and he got out of the trade. You need to follow the trend, let it work. You need to have the patience. You need to have the discipline. I'm going to jump to the next biggest issue I've seen traders fail. They think they put on a trade. It has to work. I bought, let's say, I don't know, Melanex, one of the strongest stocks. I didn't buy it. I'm just using it as an example. For all whatever logical reasons that any investor would say. Or I bought Apple. Everyone loves Apple. Apple can't go down. Well, let me tell you, anything can happen to Apple. It can go to $100 or it can go to $1,000. So the fact is, they don't really believe that anything can happen. They don't want to be wrong. There's no right or wrong. The only wrong is not following your plan, your trading plan, which trading plan, just to make sure that we're all in sync. You need to know exactly what to buy. I explained that. There's an indicator that I give to my one-on-one or even the home study. It's a ranking system that I know what I should even look at. That's the first issue. Then you need basically an entry. Entry is either a breakout or a retracement. But then you don't just do that. You go through all series of steps based on risk management. So you don't just buy every breakout, because the reality is most breakouts don't work. The fact is, you have to manage the risk actively, that you believe anything can happen. That, you know what, let's say you buy Apple today at $6.70, and it goes down $20. Then it goes down another $50. You know, the people that blow up say it's going to come back. It's going to come back. Well, you know what? I'm going to show you an example where the Swiss franc so far hasn't come back. This is the second biggest mistake ever. Not trading with a stop, not believing that anything can happen, because let's say, look what happened here. Here's this nice great trade I was in. Violent downturn. I remember it. It was on, they always do these interventions on like Sunday nights, like with the Japanese yen, and it's just like, you sit back and you go, my God, look at that. And then it hits your stop and you exit. That's it. You're out. You're not saying, oh, it's going to come back, or I should have made more money, or whatever. The fact is, you follow the plan. There is nothing not to follow the plan. If you don't follow the plan and exit where you should exit, you're going to get hurt. You're going to get hurt violently. Look at this, like here. This is a huge move from the 140s down to the hundreds. A 40% move before you blink. Oh, and then, okay, it's coming back. Oh, and then it only fails more. You can see, I mean, I always play with these, and it's very powerful. There's, actually, the work is based on a guy from the 80s, that to get a heads up when a trend, when you have a parabolic trend, when it's ending. And it always gets retested. And you can see it where it did retest and failed. And this becomes something, if you want, it's like more for advanced students. It becomes another idea how to go short. Low risk bet. And especially when you're taking out the trend line. And I'm writing these. The other thing I just want to say, let me jump over to here real quick. 1 second. I'm starting these little, little mini powerful power study guides, I call them. Because the fact is, I personally don't have time to read a book 200, 300 pages at a pop. I don't know about your time, but so I'm writing these little mini courses to help people really get down to it, to know what to do in a situation, the psychology, and they come with videos also. But I'm going to write one going back on this simple concept about 60–80% of the time that you can tell when a trend is ending and reversing. It's a very powerful methodology, and I had it up on this chart. But basically, there are two major mistakes. I'm going to make like a little bit of a review. One is not following the trend, fighting a trend. Again, I invite you, don't take my word for it, do an internet search on this guy Dighton, D-I-G-H-T-O-N, and it was called Dighton Capital USA. He blew up. Imagine the stupidity of this, a $300 or $200 million money management firm on one trade. He was down 80 some odd %, and you know what? He ended up being right, but he blew out his business. He's not the only one. There's many, many other money managers that do this. They fight it. They think fundamentally that the trend, you know, it's gone too far. It has to turn around. Well, those people go broke doing that. My goal is to keep you compounding money. The other major mistake is trading, believing that the trade has to work. It doesn't. Most trades do not work. The main fact to realize is you must have stops to protect yourself. And then, you know, there's always that argument, people saying, well, how about I use mental stops? You know what? I've seen more people freeze like a deer in the headlights, and they believe it's going to come back. I have hard stops. When I enter my orders, actually I enter my orders at around 5:30, 5 o'clock in the morning, because I'm overseas, so it hits the night markets, that all of mine are, they're not limit orders, they're buy stops, sell stops, buy stops, sell stops. It hits it, there's nothing to think about, because if I try to work it or massage it or this it, that it, you know what? I can get my head handed to me. And I got 3 kids, a wife, golden retriever, and I don't know what the other dog is. She's kind of a mix of like 10 different things, but she's sweet. And everything falls on my shoulders. So I don't plan on blowing up. But anything can happen when we trade. So I always keep that in the back of my mind, that anything can happen. That's why I trade with stops. I trade with the plan. And I invite you to learn more if you want. And, you know, again, you can read my book. I'm here to answer your questions. Again, I gave you an example of a guy that actually it's in Marhedge. If you want to hang on, here's the, one second. Let me see if I can find it real quick. 1 second. Bear with me. One sec. Here it goes. This is such a powerful article that I really invite you to email me. And you can see it. Let me go to page 3. And let's find it. Okay. Let me move this over and you can actually read it. Okay. Here it is. His first client, it was 1988, $300,000. Despite he pulled out $1 million, and now it's, I don't even know the date of this article. We can go back and look. It was 2003. Imagine what it is now. It's $18 million. 9 years more. I mean, this is what compounding is. This is what I want to teach you. You have 2 choices. One is you can do it yourself and learn how to do it. It's doable. But don't expect to be a doctor overnight. It's a process. It's a process to become a doctor. It's a process to learn how to trade. And then also, I mean, again, I allocate to other money managers. I manage money, but I'm not shy enough to, you know, allocate to other people because, again, my goal is to compound money. I want to thank you for your time. I want to, hopefully that this was, what's the word I want to say, informative, and that you've learned something from it. And now I'm going to open it up for some quick questions. And if you have a question, just put your hand up and actually go to the questions. Let's see what we got. We got a couple. Let me see if I can make this thing bigger. Okay. With your new book and home study course, besides psychology, can I methodology, know-how, money management, your new book and home study course? Well, there's kind of big differences. Each of the different products have their own idea. Here. Basically, one-on-one, I'm holding your hand. We have meetings, consistent meetings going back and forth through something like this. It's a go-to, it's like right now this is a go-to webinar. I have a go-to meeting with you. The other is I have a, basically, if you want, you just buy the book. There's stuff in the book. You're going to learn a lot. It's a great book. And there's a really famous money manager that he wrote the foreword of my book. And again, email me, Andrew@trendfollowingmentor.com, and I'll email you the foreword of a book. His name is David Drews, and basically he's been trading since the 1980s, and he said he wished he had bought my book 30 years ago. He would have made a lot more money and not made as many mistakes. So you can pick up the book. It's coming out in the fall. Or the other alternative is I have this home study guide. It's about 100 pages or so, maybe a little more, a little less. And then I have about 3 videos on there, and it encompasses, these things. But I'm going to be writing more of these little short guides. It's like when we were in school, they had these things called Cliff Notes, which instead of reading whatever the book is, one of these long 300-page books, you read a Cliff Notes that are 10, 20 pages. You get the idea, and you get it. That's the point of this, not to waste a lot of time and to make it powerful and to start trading. See if there's any other questions. Oops. Let's see. 1 second. Do not display this question. I'm not sure how to get rid of this. Let's see. Are there any other questions? Oh, there's more questions. Oh, same person. Hopefully, if I didn't answer your question, just put your hand up, and I'll know in a second. 1 sec. Oh, okay. Type your question again and answer up, okay? And I'll try to help. Oh, no, you got it. Okay. Okay. If there are any other questions or any other issues, well, again, I want to thank everyone for coming. Again, my goal is to educate you. Oh, here, Con has a question. Sorry. Let's see what Con's question is. Oh, George, in your study guide, do you teach short selling? Actually, short selling is the same. You're going to know exactly where you are at any one point. But the thing with short selling is it's a lot more, it's harder. And also the other issue is there's times you can make a lot of money. Like in 2008, we have these violent, turn downs and things like that. But then you have these bounces back. I mean, you really want to buy quiet markets that are breaking out. That's where you make your most money. But yes, to go long and to go short, it's the same thing. It's the same rules. You identify. Going back to here, again, I don't have Metastock open, but you identify. What I do is I identify the strongest markets, identify the weakest markets. I want to buy the strongest markets if I can put on a low risk bet. I want to sell the weakest markets if I can put on a low risk bet. But when you're going into a bear market, let's say just in the stock market, it gets a little bit harder because you have a lot of big, thrusts down and thrusts up. So you have to be a lot more careful, but the concepts are the same. Please confirm when we enter the market for buying shares. I don't follow the whole question. Please confirm when we enter the market for buying shares. If you can elaborate a little bit there, Con, I don't follow your question. If you can just finish it, just type a little bit more there. I appreciate it. Let's see. Con, are you there? Okay, you got it. Okay. All right. Again, basically, I invite you to, here's my email again. Whoops, let me move this down. Sorry about that, guys. You can email me here. And if you have any of your questions, I'll try to help you, try to direct you. And again, my goal is to help you succeed, to compound money over very long periods of time, and to make this a lifetime strategy as it's been for me, and God willing, for the next 30, 40 years. Thank you again for everyone for attending.